Welcome to Wall Street Station. This is a channel focused on updating you on stock market, crypto, commodities, and other financial asset classes. Today, as the episode is offline, we are going through the educational one, and we'll study one of the biggest misconception in trading and technical analysis. That's what I mean. This is trading based on merely supports and resistances. So this is the idea that often is breached by the market makers that are trying to drop you out of the market. So how to avoid this and how to improve this idea in order to not get caught into this financial trap by other more educated or professional traders. So let's get straight to our today's presentation. So right here you have a US 100 index. So it's a index for technological stocks. So US 100 right here you will find without any type of drawing tools that is used in a technical analysis. Right now I will just turn it on and you can find that whenever the price is rebounding out of the specific price, it normally is used in a technical analysis. This point is used as a support or resistance. So that's normally a line that is just lined from one to the second peak or the trough. Right here you also can find a trend line, but I'm not going through this right now. Supports and resistances are the lines that often work interchangeably. So support is becoming a resistance and resistance is becoming a support. So with this support, you have a chance that this support will become or turn to the support. So this resistance is very likely to become a support right in the future. I don't mind that it will become the support right away, right after this correction happens, but it means that whenever the price will try to go through this line, there will be a very strong demand on this level that is just diverged with 15.282. So right above you have a even more important concept than its support and resistance. So right here you can find the blue box on US 100. So I mean that blue box is just being constructed by remarking that area of weeks, upper weeks this time, and it means that in the past was the area where those sellers started to come up. So this time on the chart, if we just go back, within this price range of 15.905 and 16.022, there is a very high likelihood that the sellers will come over once again. The stronger previously the sellers started to come over, the stronger they will possibly come over once again when the price will get to this level. So why I don't use just merely the trend line right here. Right here you can find that within those condition areas there very often an accumulation or distribution takes place. The accumulation is where the traders are preparing for the stock to buy in a larger chunk of their portfolio, whereas distribution are normally the phase of preparation of the market to sell the stock in a stronger manner. So we can distinguish those two by how those liquidity zones are formed. Just look at D40. So for D40, so it's German index. Just look at congestion zones. Congestion zones, I mean accumulation this time. So those are the areas where the turning points take place. And when trends are shifting from a possible correction or a downtrend to an uptrend or vice versa. This time, let's talk about the default accumulation phase. Back in late December of 2022, before this bull market to happen, we could find that the price action started to, I will just revert to that. Price action started to form a kind of a zigzag formation, but those zigzags on a 4-hour chart, as 1 hour is not maybe much visible. On 4-hour chart, let me jump once again back there. On 4-hour chart, we had much stronger correlation where there were very strong buy waves and very strong sell waves indeed. And right on daily chart, we'll possibly go it through even more clear. So on a daily chart, we could find that when this buying candle has been engulfed by this selling pressure, right after the next trading 24 hours, those buyers not only has covered this selling candlestick, but also has formed wicks that engulfed totally the previous one. So on the accumulation phase, we are awaiting those engulfing patterns, that are symbolizing the power of bulls. But those candlesticks may be formed interchangeably. That's why we need to summarize and just make a recap of where this the bull side of the market right now is sitting at. Whether it's a more selling type of candlesticks that are usually red one, or more green one that are overlapping or engulfing the red ones, so I mean the bear candlesticks. Right now, let's talk about the default distribution phase. So we had back in February and March of 2023 on default the same financial asset, the distribution mode that was turned right back here. So let's talk about this channel, this horizontal channel. So in relation to what just been said, we could find that we have studied right back the power of bulls and bears. Whenever there was more bulls, more engulfs by bulls, it usually meant that was a accumulation phase. However, this time is a bit different. Right here, we can find it the engulfing candlestick that was formed back in 24th of February was tried to be engulfed by the next day's candle, but it couldn't really managed. It just reverted not really much more than 50% of previous candle, so it means it's too little to revert that tendency. Anyway, the market started to right back then to push many traders into a trap, as many of traders have written the market properly and started selling back when the market has fallen below this red candle, this very large candlestick head. It was a harbinger of a drawdown. But right back then, the bullish type of a momentum has stepped in, and we could find that it was just a total trap. But we can't or we shouldn't open any type of positions before the close of a candle won't have its place below its price of a candle we are betting on as a negation, and as a habit of negation. So this type of candle hasn't been negated by daily closure on the type. That's why we should just await for this one to happen and right back then step in. So those traders that were impatient started to step in. So those impatient traders that has fallen into a trap of a sell side type of a market right back then had to rescue itself and haven't really found out in many cases that it was just another type of a distribution that is very often called as a first spark in a first. This time it was even twice and second price. So those traders that were impatient on taking a position on a sell side had to rescue by this very strong candle that was really crushing many traders, and right back then it was a kind of a unreasonable to take position before this candle eventually take this closure below this candle take place. So those traders had to possibly revert to the market or have really scared away themselves and didn't want to fall into another type of trades. So this what's called very often in a distribution phase a second or third spike before the turn away. And inflection point that took place on 9th of March was the one that you could bet against the D40. So analyzing distribution zones and accumulation zones are very important in understanding the market structure. You need to make them advantages for you, and one of the common strategy is to identify a distribution zone by observing a breakout and retest on a lower time frames. So just looking at what will happen right here. If the support right there that was back a resistance is forming, whether it's a solid one or not. If it's not, there is more likely, if it had a kind of a remarking signs that is a distribution, that it will collapse anyway. So there are very often the concepts of dirty retests where the market breaks out, returns to the zone, and then continues its trend backwards. So understanding these concepts can help you build a more robust trading strategy. So accumulation and distribution zones are crucial areas on the price chart that signify turning points in the market. If you just will understand them, you will get to know where the balance of power shifts between bearish and bullish trends, and that's really powerful tool. Just observe many consolidations and just find out the differences between them. I've just pointed the concept by analyzing and distinguishing the accumulation and distribution by analyzing the candlesticks that goes together, but you can also look for different patterns. If within the consolidation area, we'll just let's look at, for instance, this one. If we just find out a price going at first like this, but right after it will just try to congest itself, it resembles more like a stickiness to one of the boundaries. When it's getting more sticky, it will have a higher chance that it will break anytime soon. Also, you may try to look for any types of price formation, such as asymmetrical or ascending triangles, and just acting upon how how those formations work normally. So the pattern within a consolidation pattern is absolutely the powerful tool to use. As well, very important aspect is observing a deceleration. Also, very important aspect is observing the deceleration or acceleration candles that might be essential for understanding and finding out where the market will have a turning point. So if we just look through this type of consolidation, when the price moves like this and right back after, it will just speed up and will tighten its range. It means that normally it would mean the price is preparing for a potential turn in this or other side. But this with juxtaposition of patterns and type of candlesticks gives you everything you need to know about it. Also, you can drop to lower time frames to spot these deceleration signs more clearly and take advantage of potential trade setups. And always don't become too rigid in sticking it to one direction that can lead to missed opportunities and potential losses. So as a recap, as a trader, you need to be aware of dynamic support and resistance shifting. So whenever the price is hitting the point, there might be a liquidity hunters that are just going through the price and reverting back after. So if resistances and supports will work, the trading will be much easier. But the market is a zero-sum game, so not everyone can really take money off the table. You need to be flexible. So smart money may manipulate price to clear out liquidity and trap retail traders. That's why you need to use a trading areas as a possible demand or supply zones rather than the support and resistances. But supports and resistances are merely the idea, the concept within which the price should stay in. But it may often get breached by price action, and you need to cover another types of study right after, whether it's a price action that may lead to possible reversal, or is it just a trap that is not really reflecting the former price action and shouldn't really take place. It needs a consistency to comprehend this, but it's absolutely useful. And that's it in today's episode. Thank you very much for tuning in and sticking around. We are seeing each other tomorrow, 8 a.m. ET time. If you've enjoyed this one, you may share it or like it or even subscribe to the channel. Thank you and see ya.